Boy, one thing that this meeting really showed is that the Fed is more divided than any time that I can remember in my professional history. So the SEP, the Summary of Economic Projections, this is where the Fed members project where they think the unemployment rate, inflation, GDP, and of course, the Fed funds rate is going to be. So for this year, they think the unemployment rate is going to go from its current level of 4.3 to 4.5%. They think core PCE, which right now is 2.9%, is going to end the year a little bit higher at 3.1%. So they're anticipating that to happen, mostly due to tariffs. They think GDP is going to be 1.6%. Now, compared to their previous projection in June, it's gone up from 1.4, but that's still pretty anemic growth that they're forecasting. And then this is something everybody was watching. What is the Fed projecting with their dots plot chart, which shows where all 19 Fed members anonymously think the Fed funds rate is going to be this year? Well, it showed a lot of division. So one Fed member said they want to hike. Now, I don't think they really want to hike, but that was them showing their dismay for the 25 basis point cut on September 17th and that they disagreed with it. However, when it came time to vote on the cut, they fell in line with the Fed chair. Then you have 6 Fed members that want no more cuts this year. You have 2 that want 125 basis point cut, and then you have 9 that want 2 more 25 basis point cuts. And then you had one, and we can all guess who this is pretty accurately. It's Stephen Mirren, who said he wants 125 basis points more in cuts this year. Now, that would imply a 75 basis point cut at one of the meetings and a 50 at the other, because there's 2 meetings left this year, October 29th and December 10th. So, Stephen Mirren, his views are a little bit different than most of the other, or if not all of the other Fed members, because of where he believes the neutral rate of the Fed funds rate to be. He thinks it's much, much, much lower. He wants to see the Fed funds rate down in the 2 to 2.5% range, where most Fed members think neutral is closer to 3. Some think it's above that. It depends where you think R star and the neutral rate is for the Fed funds rate. And listen, that's a moving target, and it's something that people have opposing views on. But this Fed was very, very divided. And, Tony, after we spoke last time, I had showed this chart, how last year, at the end of 2024, September 18th, the Fed cut 50 and rates moved up. And then November they cut, December they cut 25, and rates moved the other way. And everybody's saying, see, Fed cutting doesn't help mortgage rates. And while it's not a direct correlation, people forgot that the markets are forward looking, and rates moved down almost 0.75% in anticipation of the September cut. And then what happened? Well, they cut. Rates were stable for a couple of weeks. And then October 4th, what happened? We got the monster September jobs report that really started to send rates higher. Same thing happened in November. Same thing happened in December. As I mentioned, we're learning now that 52% of the jobs they said happened last year weren't even real, but that had real consequences for mortgage rates and for us in our business. And that's why it kind of pisses me off when you see some of these inaccuracies, because it has real consequences on our business. But over time, and I showed this, that, hey, mortgage rates, it's not perfect. It's not in lockstep, but they do correlate very well to the Fed funds rate, which is why I thought that this time around, we would see it help mortgage rates. And barring blockbuster jobs numbers, I think rates can remain attractive for a prolonged period of time. Now, here's a chart that I pulled showing you the 10-year. And this was August 22nd. The 10-year was at 433. This is when we learned at the Jackson Hole, Wyoming meeting, where Fed Chair Powell telegraphed for the first time the Fed was going to cut on September 17th. 10-year was at 433. Right before the Fed announced rates were cut 25 basis points on the 17th, the 10-year, it actually dipped beneath 4% for a little bit, but it was in the very low 4s. So clearly, the market was pricing in, even on the long end, the rate cut. And mortgage rates came down over that same period of time, 0.3%. Now, since the Fed cut, have rates moved up a little bit? Certainly have. One of the things that hurt us was the reason why the Fed cut rates was because the jobs market was showing a lot of weakness. And while we didn't get another jobs report, we got an initial claims report that next day, or that day, I should say, and what it showed is a very low level of initial jobless claims. And the previous week was like 264,000, the highest we've seen in a while. it dropped down to 231,000. So the Fed's cutting because the labor market's showing weakness, but then you got what shows to be less firings and a little bit of a stronger labor market, at least from that report. But it's also the reason why I'm saying I think this jobs report on October 3rd is going to be absolutely critical. And I really think it is going to dictate what the Fed does at the last two meetings this year. If we get a weak jobs report, weak job creations, the unemployment rate either stays the same or goes up to 4.4, I think that solidifies at least one, probably potentially two more cuts this year. If we get out of nowhere a strong jobs report, Tony, and you see strong job creations, you see the unemployment rate go to 4.2, boy, that really throws a wrench in potential cuts for the rest of the year. And we could maybe not see them. And that will also impact mortgage rates negatively. Remember, last year, Fed was cutting. And the thing, in my opinion, that really hurt us was those blockbuster jobs numbers. This year can be different so long as we continue to see weak labor numbers, which it doesn't seem to me that there's any reason that should change. We're seeing a lot of weakness there in the labor market, but BLS hasn't exactly been accurate historically.
Yeah. Couple follow-up questions, and you make a really good point. I hope that we don't repeat what happened last year and follow, what should have been a good Fed decision to lower at least a quarter and follow that up with a strong jobs number to really reverse things. And I guess we'll have to wait until the 1st of October to see exactly how that plays out.
On the 3rd.
On the 3rd. Okay, perfect.